Hello, good evening, everybody, and welcome to tonight's webinar, Fundamental Analysis, Drivers in the News. Before we get into the webinar and what we're going to discuss today, the first thing, as by always, the risk disclaimer. So I'm going to give you all a minute to read that. And I think that's long enough. All right, so what are we going to discuss today? Actually, quite a few things, and it's very theoretical, but we will be using charts as well a little bit down the line. Firstly, I'll make a short explanation about myself, a little bit, what I do and who I am. Then we're going to discuss what fundamental drivers are, and then what we discuss fundamentals in retail trade. Then we're going to iterate a little bit more on the fundamental drivers, and I'll discuss the majors, including commodities and stocks. So you have an idea of what these drivers are, that might help you a little bit in the back of your mind to understand why certain things grow the way they do. Now, we'll also look at preparation before the announcement, which is basically if you're going to be trading with news announcements, how do you prep for that? How do you set your charts up? And we're going to look at how to trade with that during both short-term trades and long-term trades. And then obviously with existing trades and non-existing and pending and all these kinds of things. Now, at the end of the webinar, we're going to have a Q&A session as always. Then you guys get the floor, and then we'll take it from there. But first and foremost, about me. So my name is Mike Rotting. I am currently 36, married, got a kid. I live in Athens in Greece. I'm originally from the Netherlands. This is where I studied international business, with a knack for the economic side of things. And I took a side course on math because I was bored. During this period is when I actually stumbled on trading, and at the time it was binary options. That's what I started with. Obviously, it's banned now because it's basically gambling, but yeah, that's what I started off with, and I felt the same way. It wasn't really something, you know, good. It felt very gambling like, so I transitioned to forex over time. Um, and like most of you, the first few accounts, not that great. More down than up. Blew one or two up, obviously. And I was trying to do everything, follow all these gurus, these self-proclaimed gurus, and all these videos. And it just something didn't click. It like just didn't work for me, following other people and signals and this and that. So eventually I just threw everything out the window and step by step built everything up for myself, really started to dig into things one, concept at a time. And 3 years down the line, my first account was profitable at end of year basis and actually never changed since then. So, 15 years down the line, consistently profitable on a yearly basis. Over time, rotated a bit more out of retail trading and more into bulk investments like big lump sum investments, multi-asset funds and stuff like that. Which brings me to what I do. Obviously, apart from coaching and training on retail trading, trying to pass on my knowledge, clearly I do these webinars as well. Like today, I'm doing it for Legacy FX. On top of that, I am currently in the process of trying to become a financial advisor, so I'm going through that, licensing exams and all these kind of things. And then it's probably going to be more of a focus on the investment side of things because I have the most knack with that and experience, and try to help people transition between retail trading and bigger investments and financial planning in general. That's me in a nutshell. So, what are fundamental drivers and fundamentals? So, firstly, fundamental drivers. And this is a very important aspect. Fundamental drivers are the backbone of why a individual currency, not a pair, what makes it move. And we're going to discuss this for the majors and, like I said, commodities and stock a bit later. But you need to understand it is not the smaller announcements, that happen in the background. It is what basically gives it its strength, in its inherent strength. What would, if you would take the currency on its own, Why does it hold value? And how is that value determined compared to all the other products that are out there? So these securities all against each other, where do they get their strength? This is what the driver determines. And the driver thus determines the growth that any currency or decline that any currency can have in a year. There's usually ranges to this as well for economic reasons, but there are some aspects to drivers that are out of our influence. Actually, all of them are outside of our influence. Most of the fundamental drivers are the big geoeconomic impacts of every currency that we have no influence over. They will just determine. And when you look at bigger parties, so when you talk about long-term lump sum investors, big investors, so you talk about Goldman Sachs and Pacific and PAM and all these kind of big groups that do multi-asset investments, they focus on fundamental drivers because on average the euro will grow X% per year in value. So this is what they trade on. And obviously they trade on stock and things like that. But you have in stock, again, this similar idea. There's drivers behind certain things, and then you have established companies that just have a very steady growth, which are not money makers, but they're like your foundation because they're very stable. You can reliably say it's going to be a growth between this and this percentage a year. So that's how they work. Unfortunately for us retail traders, this is a very inefficient way of trading because we don't have that kind of cash to sit down big numbers and let them run for a prolonged period of time, a year or multiple years, and let them really benefit from this growth, which means that we have to focus on fundamentals in retail. And in Forex or CFDs or anything that you trade, in retail trading, for us that means news announcements. That's our fundamentals. The economic calendar. Now the economic calendar comes with different aspects. Now one of the places where you can find it, if you are a client of Legacy FX, you will find on their website, you will find tools. And in tools, you will find economic calendar. So first of all, there's several economic calendars. Use any you want, but I'm just going to use the one from Legacy FX for this example. Now, obviously, you have everything here sorted out. It's going to be the same everywhere because everything I have it set for the location I want to be at. I don't know why it says Helsinki, but it doesn't really matter. You can change your time zone there in case because I think in default it says the US, the New York time. So you just change it for yourself. It's on the browser, so it'll stay. This is with most of them. Most of the what do you call it, economic calendars on any of the sites, they're usually on a default time frame. They don't automatically pick up on yours. So double check the time frames before you do anything so you don't get caught off guard that you have the wrong time in your head. Now, the first most important thing to understand is what are the impact levels? Now, when we look at fundamental drivers, one of the things that, for those that watch Bloomberg a lot, you will always hear them talking about the treasury yields and the bond yields and the 10-year yields. And we have that in the news announcements as well, but they always have the lowest impact. Now, different ones have different, you have one bar or you have one skull or you have, I think it's green, yellow, and orange, or 3 flags or 3 stars. In this case, their ledger works with an empty star, a half filled star, and a full filled star, right? So, empty star means least amount of expected impact. Full star means most potentially volatile moment. But this is a temporary moment. Unless it is something more major, like a interest rate decision, where, for instance, an unexpected hike, emphasis on the unexpected part, then, or, obviously a reduction. But if it's something unexpected, then you can see an effect out of that. If it is not, if it is already factored into the market, meaning that the forecast is in line with the number that comes out, and the impact would be, let's say in this case, hollow, like this, you're not going to see the market move because this was already expected, which means that the bigger parties that make the market move already factored this price in. So nothing's going to happen. And furthermore, like I mentioned, the 10-year bonds, we see them here, but they're always hollow, even though they're part of the fundamental drivers. But the economic calendar is a short-term window. It's a temporary volatility. Now, in some cases, it can have a severe impact, but this is more often than not the exception. And this is a very big exception. It's a very big exception nowadays where the fundamental actually turns the whole thing around for the long term. So 6 months, let's say. Usually you'll see nowadays, like even the NFP, which is the one that everybody knows, the non-farm payroll, you will see that if we go pre-2008, as an example, the NFP would determine what the trend would be for an entire week for the dollar across the board based on that result. Nowadays, it barely lasts an hour. Like it goes up, goes down, and it stops in the middle somewhere. Unless it's really completely tipped out of the way. And and let's say the forecast was positive, but it came out completely negative, then you're going to have an effect that's going to linger for a day or two until there is some speech that justifies it or something like that. But even then, it won't last a week. Now, these are obviously already indicated by a star, right? So the NFP usually has a full, because if the number comes out, we expect it to give a big volatility, and I say this very loosely. Volatility is pretty much dead compared to the markets that we were talking about pre-2008. After that, the amount of money moving in the market has significantly increased. And you can understand when you're trying to move a market, if you have $100 into an asset and somebody puts in $10, he changes the price by 10%. But nowadays, that same $10 is going against $100,000 in the market. You're doing 0.1%, so nothing's happening, right? So there's a much bigger bucket, let's put it that way. So your drop is even less valuable now than it was, 20 years ago. So this is good to understand that why you see these impacts going, even though full stars, more often than not, you don't see any movement. Generally speaking, it's because the forecast was expected, and therefore the actual result, if it is similar to the forecast, generally nothing happens because it was factored in. Now, as retail traders will act on this and trade, and especially on the shorter time frame, and I mean under 1 hour, you will see a lot of people trading, but this is very, very small trades for very little gain and a lot of risk, right? Because there's no real direction. It's basically just quick fluctuation of people buying and selling at the same time, and you're trying to basically, grab a quick trade. Now, obviously, not everything has a forecast. For instance, and this is a good example, the AOD, the monetary policy meeting minutes. Well, obviously it doesn't have, because it's a meeting minutes. It's not until they get announced after the meeting's been done that we know what was discussed. And in this case, you usually have questions like, okay, but what is this? Well, in this case, we can click on it and it will just tells us a little bit about the information. Now, one of the other programs, if you go to investing.com, for instance, you can actually click on every single announcement, like for instance, let's say the trade balance, and you can go to the history and see the result of the announcements. And this is very important to do. And the reason for that is understanding what you're reading. Now, obviously, when somebody comes out with a banking policy, unless you have a degree in banking, you don't fully implement, understand the implications across the board, but you don't need to. You don't need to be an economic advisor in order to understand that certain banking policies are positive or negative, right? You only need to focus on the more important thing, and that is the overall big picture. You don't need the details You understand that if interest rates go up, this will be positive for the news because this means that they have a trust in the economy growing. Right? Makes sense, right? So strong economy, usually we see interest rates go up. So understanding your data, you can do in several ways, and that is by back testing. And you can do this by simply taking your chart and take one specific thing. So let's say euro US dollar. And then you take the fundamentals of euro that are volatile. So euro US dollar, you can take the NFP. And now you compare the NFP for the last 3 years, or go back a year even. And what you do in that year is you mark the exact day on your chart, right? So the way you could do that is, for instance, you could take a horizontal line, you find the day that the NFP was announced, and then you just put a horizontal line. And you do that like, every month that it's there, you go back and back and back and make these things. Then you go to a smaller time frame, like a 4 hours or an hour, and on that specific point, and take a look at what it's actually doing. So what did it do before the announcement, at the announcement, and after the announcement? Step one. Step two, what was the announcement compared to the expectation? And then you will start seeing a pattern where the ones that fluctuate the most is because they were outside of scope, right? They were not according to the expectation. Now, there are some exceptions to this because sometimes, like about half a year ago, the NFP was expected to be bad, like really bad. We expected like a 20K NFP, and it turned out to be actually negative 15. Yet the market didn't move at all. And it's simple because we were already expecting a terrible NFP. The fact that it was more terrible than the expected terrible didn't matter. Again, the price is factored in. We knew it was going to be terrible. Right? So this is something you need to understand. And that is what you can then factor into your trading. So understanding the data is simply a matter of reading it and then backtesting it in your chart. And then just don't do all of them at once because it's way too much info. Focus on a few majors, let's say 2, and backtest the most impactful ones. So new interest rate decisions and the core announcements, like in the US dollars example, the NFP. Now, you can usually pick them out and then backtest that. So that would be basically step 1 of the whole process. So now that you have the basic theoretical knowledge, let's go back a little bit to the drivers and actually, have a little bit of an idea. So the fundamental drivers of the majors. Well, first of all, let's talk about the US. Well, first of all, the US has a couple factors that make the US basically move, global aspects, and we know why that is. But it's also, apart from the euro, the most traded currency in the market. We also know that. But what moves it? What is the driver? Now this is where I get a little bit interactive. Who can name me some things that you think are a fundamental driver of the US dollar? Who wants to take a shot at this? All right, we got one person that said oil, nailed it. Price of gold, yeah. Oil and gold are actually tied to each other in this one. Employment, actually, not so much. It's not a driver. It's part of. Yeah, interest rate. Interest rate, again, so interest rates are more reactions to the economy. Jesus. But yes, it is a very good indicator of what drives. It's basically how the bank sees things going, right? Inflation. So inflation is a result of things. It's not a driver per se. So yeah, so we basically number one is the oil and metal markets, mainly the supply and demand fluctuations, right? So this is a very big driver. We all know the U.S. is very heavy on the oil. We're very big on gold, obviously. Um, so all the basically because everything is nominated in the U.S. dollar, the oil prices and stuff, the supply demand fluctuations obviously, you know, immediately influence the US dollar. Now, that's one. Number two, the US is just a safe haven. That's actually, part of its thing. So, the benefit of being a perceived, safe haven helps because traders are less rushy to sell off the US dollar because they trust that the US dollar will be stable. And when you think about from a trading perspective, this is actually makes it a driver. What is the investment credibility of the dollar, the safe haven? And this is where that gold comes in because gold and the US dollar are like flipping each other as safe havens. And gold is still priced in dollars. So there you go, right? The other one, yeah, that people said, obviously the federal rate policy, bearish and hawkish ideas on the market allow, the Fed to determine whether or not the interest rates are going to get hiked or reduced or stay the same. This is a direct reflection of the strength of the US dollar in its economy across the board. So this is a very big driver. And we know their policy well in advance. It's not like they just decided like over time. They might have a fluctuation change along the way, but this is usually already kind of factored in because we already know for 2021, what in the statement at the start of the fiscal year, but for the next fiscal year, for the Fed, roughly their idea is on what they're going to do. And unless something significantly changes, of course, across the year, that policy generally doesn't change. And so everything is kind of expected. The other big driver, and that's something people usually forget, is the US trade deficit and government debt. I think I need to explain that. So one of the important factors of influence for the US dollar includes obviously, the trade balance and the national country debt. Now, normally speaking, the higher the trade balance and national debt are, the less demand there is for the dollar, right? That makes sense. The more they're in debt, the less the dollar gets wanted, right? And this ties back to that safe haven. So the lower that debt is and the more stable, or in this case, it's, how little it grows, it gives that strength of the dollar staying around, right? So this is kind of what puts it back in there. And that's the major, points for the dollar. And somebody mentioned the housing market. So the internal economy of the US dollar is a lot tied into the housing market that they have, but it's not a driver of the dollar's strength. But it would be a driver for, let's say, the US's economy. It's a very big factor of the US economy. So that combined with two or three other aspects would be one of the drivers, right? And that's where we get, and that usually gets reflected in the Fed rate. Now, what is the other composite? Well, Europe had a brilliant idea. Let's get rid of all the foreign currencies and just make one. We call it the euro. Great nonsense idea, but all right. So here, we have similar drivers, but the problem is we have a lot of different countries. So how do we value the driver of a euro? Who's got a good one? Yeah, straightforward. Yeah. That's probably the biggest one, most obvious one, obviously. We got ECB policy. 3 times. So yeah, obviously the European Central Bank's policy, and that tied with the key economies in the EU region, that is the most stable, trade fund driver for the euro. So obviously things like the economy of Germany specifically would be very big. France, right? The bigger economies in the EU, Netherlands. These are very big, and then that tied with the ECB policy. Um, Now I'm currently in the south, um, and yeah, for driver wise, we know the south is not a driver for the euro because the southern part of Europe is basically like the southern part of the US. It's the poor side, right? The internal economies are very heavily reliable on tourism. They don't have much internal economy compared to the north. Germany is the other side of the aspect of that coin. They have a huge amount of natural resources and a very strong internal economy. Right? So they are definitely a driver for Europe, but I think everybody will know that. So the CPI is part of multiple assets that become a driver, and that's where the ECB policy and the key economics come in, right? So when you look at the CPI, it's just a representation of where things are standing right now, right? Consumer price index, but it doesn't necessarily make it a driver on its own. It just gives more of an idea how are people being priced, how are the consumers pricing things? Where are we standing? What's our buying power is? And that is more of an effect of, is the economy getting healthier or less healthy when it comes to purchasing power and stuff like that. So the other aspect of the euro as a driver is oil and gas dependency. Right? We're heavily reliant on the Middle East and Russia when it comes to oil and gas. And the higher the demand for these commodities is, it generally tends to weigh on the price of the euro. It's that simple, right? If there's a really high demand, so this is why you see that fluctuation in the winter. People need it less during the summer and they need it more during the winter. So obviously you're not going to see the fluctuation in the winter. It happens just before the winter. So actually during summer, you're going to get pricing on the demand just before the winter hits. So basically autumn. And then throughout winter, and then it slows back down in spring. So this is obviously a thing. But overall, if you pull a line, you would flatten it out over a year, then you get a little bit the idea. The next one is the and I touched on this a little bit, the peripheral economy. So one of the problems you have is that the EU, as economies go, have a very strong difference between each individual country. I already touched on this with the South and the North. Right? Germany on the Eastern Bloc, for instance, right? So Germany, Netherlands, France, very stable, strong, big economies. And then you look at Spain, Italy, and Greece, not so much. Right? Very fluctuant, very unpredictable, constantly, in continuous debt, very reliant on funding from the north, very reliant on tourism from the north in order to sustain their economies. So this is something you need to understand, that there's this rift. And that does put pressure on the euro. When the south starts doing really, really bad, it needs that up, you will have to fund the bottom, right? So the bigger the problem becomes on the south, the more pressure comes on the north to provide the funding to keep a balance, to keep it at zero. And that becomes harder and harder and harder. Obviously, people that live in the north are getting more and more antsy over time of, I'm paying tax to fund the south. Why? Right? So this is a very, very slippery slope. Now let's move on to the pound. So the pound, one of the big things that was a driver for the longest time has been Brexit, and it still is, because the policy makings and everything else around Brexit, it, it's just a mess, right? We knew that once Brexit was going to get pushed through, that, for instance, the export and import rulings and everything else were going to go default back to a certain default, with the agreements. But we already knew the infrastructure wasn't built for it anymore. And we see the effects of that now, right? Fishermen have huge stockpiles of fish that they can't sell because the internal economy is not nearly big enough to, for them to sell all this fish, and they're not allowed to export it. So they're stuck with dead stock, quite literally. So one of the big things about the UK, though, in itself, is that London is still considered, a global fintech and financial center. And the commodity and housing markets in the UK play a quite significant role in the pound trends. You need to understand that in London and the Northern Powerhouse, for instance, which is a project that they did to revamp and revitalize certain northern or abandoned areas, or let's put it that way, fallen behind areas, to get everything out, rebuild and reset everything. This brings a lot of foreign investment money. Yes, a lot of Asian money gets invested into London, a shocking amount actually, Russian as well. But it's very lucrative to invest into UK housing because it's a very interesting market when you think about it. It's a rental market. Not a lot of house owners. It's morely rent, and that shows. So it's very interesting to buy into that. So these are, a thing, and obviously, you have the same thing again. Your interest rates, and just generally economics right now. But these are the major ones for the pound. Now the yen is a tricky one. So again, the yen has this little bit of a safe haven. It's like the strong Asian counterpart of the dollar. And the yen has been very stable over the years, but mainly as a safe haven for traders. And when the markets see a very weird risk aversion kind of behavior, you generally see that the demand for the yen starts going up. And the funny thing about the yen is that it's also a very volatile pair in most of them, which means that it's also attracting traders, generally speaking, because it's a very volatile pair. So it's a profitable pair to trade if you trade it right. Now we know about the interest rates in Japan, obviously, so that's a big driver. I'm not going to get into that too much. And obviously the Bank of Japan's interventions, because this is a little bit different than in the rest of the world. The Bank of Japan has more power to directly influence the economy than they do in, let's say, the US or in Europe, because in Europe you only have the European Central Bank that's allowed to make statements, but they can't enforce it by law that this needs to be implemented. They can only make it as like a suggestive, like unilateral ruling, but there's exceptions per country. The National Bank of Germany, National Bank of France, National Bank of Greece, National Bank of Italy, they have their one, and then that one layers on top of it. But in Japan, they can literally directly influence the economy if if they want to. Which brings us to the Swiss franc. Now, the Swiss franc is, again, a very stable pair. It's very currency. Obviously, its position in Europe is very, very special, which again gives it that safe haven kind of feeling for traders because, well, the Swiss franc is not going anywhere. They are as, you know, isolated in trading as they are, normally speaking, in the rest of the world, right? They're independent completely. And that gives them a very strong thing. And obviously, they have huge reserves of gold. So, that does help. And the other driver, obviously, again, for the Swiss franc is the national bank's policy making, because that is the direct, accumulation of the influence that are happening in the currency. With the Canadian dollar, it's a little bit different. With the Canadian dollar, you're looking at mainly the U.S. driven, they're a U.S. export driven nation, right? So Canada is very much reliant on, the U.S. importing their stuff. So this is where the CAD gets most of its strength from, their export with the U.S. And on the flip side, the CAD is very, very reliant on the crude oil prices. I think that comes as no shock to anybody, because that commodity is literally its main export to the, brother down south. Now, that brings us to commodities. So commodities I already touched on, and they have an influence in different, like oil we discussed several times, right? CAD, obviously we have Brent, and then we have crude oil. Gold, obviously a safe haven on its own, is part of the driver for the US. Obviously is a very strong suit for the Swiss franc, but gold itself is obviously a rare metal and is heavily, heavily used in Asia for jewelry, right? So that is what moves that price. Ergo, that's how it influences the others as a driver. Now, stocks is different. The driver of a stock, whether it be a CFD version, so let's say you're trading the CFD version of Microsoft or the SP 500 or whatever, or buying actual stock, doesn't matter. The thing that determines the pricing and the strength of a stock is the yearly figures and the policy making of the company. So for stock, you need to be more specific. If you're going to invest in a specific stock and you're interested in, let's say, Netflix or Amazon or whatever, and you want to buy, let's say, 100 shares of that, then you need to understand what you're buying into. Stock does not trade the same way. Now with CFD, you can sell and buy it the same way, but if I want to buy actual stock, I can only buy, wait for the price to increase, and then sell. I cannot buy stock for a sell. That doesn't work. So you need to understand what makes it my determination that when I buy it, I expect the price to go up. Why do you expect that to happen? Well, based on their financial figures, based on their forecast, based on the strategy planning during the pandemic, very, very strong thing right now. How are they going to handle staffing? How are they going to handle furloughs? How are they going to handle, all the decision making that happens in a company affects the price of stock, because it reflects, their policy making reflects the strength of the company and its ability to deal with different situations. And that in rough is the fundamentals, of basically the major stuff. Now we get more to the active trading part. So we're going to be trading, using the news announcements, but there's several ways to go about this. And it's not for everybody. That is first and foremost, right? If you have a small account, so let's say 1,000 or less, you generally don't want to trade a news announcement on its own, because you're taking a big risk and it's quick trades, and you generally just want to have more of a consistent trading strategy. Then you want to have a cherry on the top strategy, because that's not a strategy, right? So this is what I mean, determine and applying your strategy. If you have a strategy, you need to understand how that affects, because generally speaking, your strategy is going to be for day-to-day trading, not for announcement trading. So how do you apply your day-to-day trading to an announcement trading? It's by at least taking the execution part of your strategy and your general risk factor rulings and execution rules to the table. But also look at what you're going to do in the sense of, how am I going to trade it? What am I going to trade? How long am I going to hold them? What is going to be the acceptable list? But you don't know this until you actually analyze the instrument you'll be trading, right? So You do your trend lines, you do your resistances, and you have an idea. So for instance, let's say there's an announcement in 2 hours. Let's go to an hour here. So let's go, there's an announcement in 2 hours that is expected to be positive. Well, I would rather buy when it's at the bottom, but if the announcement's in 2 hours, then I'm going to want to keep an eye on this, because usually before the announcement happens, it's going to start stalling and start, orders are going to start piling up. So you need to make your analysis and understand, like, okay, where can the fluctuations go? What is the average daily rate? And what is basically a spike? What does a spike look like in this particular pair on 4 hours, on an hour, on 30 minutes, whatever you trade on? But understand what spikes look like. How big are they? There's going to be an average there, so factor that in. Right, this is very important. Understand where the price is at the moment of the announcement. If it's at the bottom of the trend and it's a downtrend and it does need to do retrace and everything is telling you it wants to buy, and then the announcement is in the positive side, meaning in positive side going the opposite direction of the trend, then it just emphasizes that, well, it already had to do the correction back to the top of the channel to go further down. It will definitely spike up. And even if it doesn't move on the announcement, it will just justify it to go up. Right? So, you don't have to wait for the price action first, for instance. So it's very important to also say, like, let's say you want to trade the NFP. Let's say that an example. Well, analyze the instruments you will be trading. Yes, the euro, US dollar. I get that. But what else? Are you going to be trading all US pairs? Or just 3 or 4 of the majors? Right? US euro, or euro US dollar, USD CAD, USD AUD, and USD yen. 4 trades, a very short time frame. Understand what they're at, understand what they look like, understand what the counter weight is of the other pair at the moment. What is their strength individually? Once you've done that, you can then understand from, okay, so when do I actually execute the trade? Well, this is a little bit different. And what I mean by different is that there's different ways to approach this. And I'm not talking about when you have an active trade. We'll get back to that later. Let's say you want to open a new trade. Either you go in pre-announcement, understanding that, with all the analysis that you've done, the possible height that it can spike, and you basically pre-factor the trade in, you have a set stop loss and a set take profit. Or you wait 10 minutes to after the announcement, 5 to 10 minutes. Because the first 5 minutes is when all the inexperienced retail traders are randomly clicking buttons, and that is where that up, down, up, down, up, down, that weird spiking comes from. It's just thousands of people clicking buy and sell at the same time because nobody understands what the hell they're doing. Once that's settled down, you just casually open your trade. Now, another option, and this is the more risky one, by the way, right? The other option is trade the reversal. Usually what happens after a news announcement, it will spike in one direction and then correct itself afterwards to go back to the price that it was at. And then if the spike was in direction of the trend, it will again go to that price level. So it'll go up again, let's say. But if it was against the trend, okay, when you trade the reversal, the second gets to entry price, you hold it for a second, because here's where the interesting part comes. It can now flip the other way, because everybody that was already in the opposite direction expecting a change of direction. So let's say the trend is up and it spiked down. Now it corrected itself back up. What happened with a lot of people that took that sell earlier have now closed it. So that selling pressure is now gone. So that buy could actually push past where the price was, and then people that wanted to do the sell initially will sell again. And especially when this is around even numbers, right? So let's for say example, the price is we're currently at 110, and it goes to 1.5, right? Halves and wholes is, a heaven when it comes to pending orders. Because we all have this OCD problem where nobody puts the pending order at 1.3148. It's always, oh, then I'll put it at 1.32 or 1.3, right? You understand it? If it's like 1.3481, then people will put it at 1.35. OCD thing. So this is where you see the resistance that are at these half and whole numbers, why they're so much stronger than the ones in between. Because people put pending orders there, especially if it's in line with trend lines and stuff like that. Because retail traders, we trade technically. We don't trade as much fundamental. Right, for us, technicals are probably 70% and 30% fundamental when you have a full balance. When you go to the professional side, it's the other way around. It's probably 80% fundamental based and 20% technical, because they plan a trade for a year or more. So it's a completely different way of trading. But what is important, regardless of when you act, so before, during, or after, what is important is setting a goal and understanding your acceptable risk levels. And I say acceptable risk levels because I have, in my experience, had people come to me with their accounts that they've blown up because they took a standard lot trade on a $1,000 account during the NFP. But I was certain it was going to be a buy, but then it fluctuated down. I got margin called, and then it went up. So I won this trade. No, you didn't. You blew up the account. Stop loss, first of all, which you already know, regardless if you trade during, before, or after. You know where the nearest resistance is of both directions. You know where the stop loss is going to be determined. If you don't know how to do stop loss determination, I made a webinar for that. Just look it on Legacy FX YouTube. But once you've accepted and understood where your stop loss is going to be, you already know, depending on the entry point, what roughly the lot size needs to be to fit your acceptable risk based on your risk profile. Now, if your standard trades hold a, let's take a low side, you're all defensive and small accounts, let's say 3% risk per trade. Then during a news announcement, it should be 1.5 or 2. Because you're taking a more volatile, uneven trade, but at the same time, you want to have the consistent trades to be your foundation, and then these are the underlying trades. Always trade with a stop loss and always have a fixed percentage of account as a risk per trade in mind, that is your acceptable risk. And once you get there, take the loss. It didn't work out. Better luck next time. Don't try to, well, shit, okay, the sell didn't work, so I'll close the sell, take the loss, but take a buy instead. So when it goes back, oh, now I lost the buy as well because I held on to it too long. So it did turn into a sell, but that's okay. I'll take a sell again. I know that train of thought sounds familiar to at least 2 of you. Well, there's 150 of you, so I'm guaranteeing there's more of you that thought that. Well, the sell's not working, I'll take a buy. The buy is not working, so I'll take a sell again. And then you end up with 3 losses on the same thing. That sound familiar to anybody? Especially during news announcement when things are moving. Yeah. Yeah, that sounds familiar. Yeah. So this is exactly it. You panic. And this won't happen if you just have a fixed strategy in mind and just walk away if it doesn't work out. And trading on fundamentals on news announcement can be a core strategy, but it's a very risky and very time efficient, and it takes a lot of planning. Doing the more consistent trading is important because, especially as retail traders of small accounts, you want to build up consistency. That is where your profit is going to be. You don't want to become a millionaire overnight. It'd be amazing if it happened. It's not going to happen. Okay? It takes years to grow an account. And that's not taking the money out on a monthly basis, like use it as a second income. No. Let's say you have $100,000 as an account. Oh, a little bit side note, but okay. Let's say you have $100,000 as a side note. If you make 20% growth a year on a $100,000 account, you make $20,000. That's a little under $2,000 a month. That's barely better than what you're doing, probably. As a, if we look at Europe as the minimal wage, but you already need to have 100 grand, so $100,000. So I don't know where that came from. One of the other things I want to point out is not so much with legacy effects, but if you have a different thing, spreads and commissions are fluctuant during news announcement. Spread goes up. And in some cases, it depends on the broker you have. Again, I don't think legacy effects, but the commissions could increase during, so the price of opening and closing the trade could go up during volatile times, up to 5 times, 500%, the spread at least. And obviously this is much more with exotics and minors than it is with majors, like Euro US dollar, not so much. But keep that in mind because your opening is going to have a slight gap, a little bit more than usual. So factor that in. Whoops. So now let's actually trade a little bit with fundamentals. So short term, I already touched on this, is trading the volatility. What we mean by trading the volatility is trading that spike during the announcement. Now you can just do this by just opening beforehand or during. And we discussed both aspects, but what is consistent on both aspects is that you already know where your stop loss is going to be, regardless of when and where you open it, because the market has told you where the nearest resistance is that you should be outside, where it should not go. So for instance, in this example, let's say, I want to take a buy here, right? Now I know this is the bottom of the trend line, and this is a weekly one, I think. Yeah, so this is the weekly trend. So in a day, it shouldn't be below this, and I want to take a buy. Now there's a resistance there, and I know from a day point, a recent one is somewhere over here, which is also a little bit correspondent with here. So regardless of where this is going to be during the announcement, so if I go in an hour, for instance, and let's say it's over here, my stop loss will 100% be underneath this line, these two combined lines. So it's somewhere over here. This is the middle. No matter where I open this, might take profit, however, in this case, spike. So the average is like that. So it would have a range of roughly somewhere over here. So in order to make the ratios work, I would have to enter somewhere here. Then I have a nice, 3-to-1 ratio if I can get in somewhere over here. But it depends on where the market is at the new time of the announcement. So let's say it's in 4 hours. Then in 3.5 hours, I'm going to check where the market is. Did it already go up? If it did, I have a problem because I can't take a good stop loss on that trade. So then you're better off just walking away because stop loss stays here. This is the only place where it belongs. It doesn't belong here. Let's say the market price is here. It doesn't belong here. Why not? Because it's in the daily range. See? Like last 3 days, like I need to be outside of that. If I do it anywhere in here, it can just spike after the announcement, even if it goes up. After the announcement, just spike down and hit my stop loss again, which is not what I want. Which brings me to pending order and manual execution. Both are fine. Manual is better. Pending is very effective once you have a good understanding on the fundamental announcement that's about to happen and its results, and have a good understanding of the price levels of the particular security that you will be trading, pair. So in this case, for instance, I can say I want to put a buy stop in here. because I know if it gets here, it shouldn't fluctuate much further down. And I can already say on this that I want my stop loss to be, underneath whatever this line is, 108.45. So my stop loss needs to be at least, and I can preset that 1.08. So let's go 1. See again, OCD, sorry. Right, so, whoops, there. Now I can just move it. Now I have my pending order. I don't care about my take profit. I can move one, I can make one, obviously. But this will always keep the distance. I don't care about the distance. But by determining where my stop loss is going to be beforehand, I also know, because I determined the stop loss beforehand, I'm not going to do it now. Man, where is it? Come here. There you go. And then once you have that set up and you have your stop loss so the way you do that first is you determine your stop loss first. So I want to go in here. My stop loss needs to be here. That's okay, 20 pips in this case. All right, 20 pips. If my account is 1,000 and I want to take a 3% risk on this trade, okay, how much would be? Well, 10 is 100, so 5 is 50, so 3 is 30, is 20 pips, so 1.5 mini lot. There we go. So I'd say a pending order for 1.5 mini lot here. And again, I did it just in simple execution, but anyway. Can I change the lot size after here? No, right? No, not on this one. Okay, so here you would change the buy limit. Can you do it this way? Yeah, here, see? So 1.5 mini lot. The stop loss I can preset 1.08. I have plenty of time. The market's not going anywhere, right? So I can just do this in all time. Market's not going anywhere. My take profit, whatever, don't really care much. It's going to be 108.5. Is it 08? Yeah, 08. 85. And then buy. So I don't want to buy market. Ah, shit. No, that's not what I meant to do. I buggered up. All right, anyway, it doesn't matter. So anyway, you put in the pending order, so the buy limit. I need to change it here on this one. No, not. Sometimes this just doesn't want to do what you want it to do, right? There you go. Now we have the right lot size that we determined. I can modify my stop loss now. 1.00. What did we say? It's 8. Perfect. And now I can make my take profit already. Right, so my take profit would be, well, I basically want to take the safe bet. I don't want to go for like it wants to spike all the way there. What's my ratio going to be? Somewhere here, not great. But during the spike, it'll probably go a little bit through. So I'll go for 8.7. If that would be a scenario, right? And then, now that I have all of this, I also want to secure my stake profit the second that, now this is dependent on who you're trading with. But with Legacy FX, I know that on MT5 that they use, trailing stops only execute after a certain amount is in profit. Not calculated from stop loss, calculated from entry point. There are other brokers, when you say trailing stop, it activates the second you say trailing stop, and it just calculates a stop loss distant from whatever the market is at that point, and then moves with it. So be careful with that. So about halfway is 224 points. So now I also want to modify this. Nope. I want to set up, oh, come on, work with me here. Trailing stop of 250 points, 225, 250. So when it gets to 25 pips in profit, this will automatically move during the announcement. Remember, this is a short-term thing, so it's going to go really fast. If I am not sure that I'm going to be able to view that happening because I have 20 of these pending orders set, which you should never have, but let's say the 4 that I mentioned, you have 4 of them. You're not going to watch manually 4 screens at once. I mean, you can, you just put the 4 next to each other. I'm not saying you can't, but you shouldn't, because you're just going to start panicking. You did your due diligence, you did your analysis, you set up your trades. Now what you're going to do is you're going to pour yourself a whiskey or a Mai Tai or whatever it is, a cup of coffee, a cup of tea. You're going to sit in the garden, on the roof, or anywhere, but not in front of the PC. And an hour after the announcement, you come back and see how you did. Because you either lost money or you made money. That's it. You accepted the risk. When this is a mindset people need to get. When you open a trade and you set a stop loss on a news announcement trade, you are committed to that. You have to let it run its course. You cannot start messing around with it. If you got it wrong, you got it wrong. Better luck next time. Losing money is not a problem. Consistently losing money is a problem. But fundamental trading is not a consistent thing. Your core foundation, fundamental, your 10 trade portfolio is your consistent trade that you have another 10 replacements for. And you might, if you're telling me now like 10 trades at once, what are you nuts? Yes, any account can have 10 trades. Well, most accounts can have 10 active trades at once with the proper risk management if you use variable lot size. And that way you have a healthy portfolio that's diversified, a little bit of natural hedging maybe in there. You have a couple different things that are not correlated to each other. Obviously, you control your exposure. You should never have that issue. You will always have things moving at the same time. But that is the short-term trend. So that's when it happens. But what about the long term? Well, the long-term trade is a little bit different because the long term is either you have existing trades or new trades. But when you have existing trades, if the announcement is within 48 hours of you opening a trade, then you made a boo-boo because you should have looked at the economic calendar and planned ahead 48 hours to see what announcements may happen in the next 48 hours that might upset my trade while it is still building up its initial stage. So this should be part of your strategy textbook. Any announcements in 48 hours? Question mark? Check. Now, let's say you have a trade open. And in this scenario, the trade is, I don't know, 40 pips in profit, something small. There's two scenarios you can do. If you expect the announcement to be negative, impacting your trade, there is no reason for you to risk losing 40 pips profit. Close the bloody trade. Even if you know it will go to your take profit ever, close the bloody trade. And during the announcement, when it fluctuates down, reinitiate the trade at a better entry point than you had. And if it goes up, well, unfortunate, but it's better to be safe than sorry. Now, the other side, which is another option, is you can simply move your stop loss to 0. And I don't know why so many people don't do that. Yeah, but it nips my thing then, and then it goes to take profit. Now I should have hit like my profit point, and but I went out at 0. Okay, but not losing is still winning. Because as long as you're not losing money, you're still trading. The only side you're trying to control is the losing side. By controlling the losing side, you automatically get a winning side. And people tell me that all the time. Yeah, but every time I do that, it will go to my take profit after. Does it? Then how come for all the other trades that you don't have to do this intervention, they also hit your stop loss and not your take profit? It's one of those things like what you think you see is not correct. If you would look at the statistical repetition, if you would do it 20 times, it is far more consistent to do what I just said than what you just thought. And this you can just backtest, just go in the back, just backtest it. Because what you want is the consistency. Yes, I know from time to time you will have that one that after you close it goes to your take profit. There is more often than not, however, the one that you didn't close because you thought that would happen and it hit your stop loss instead, because you also didn't want to move the stop loss to zero. And I know for a fact that there's a few of you going like, yeah, that sounds familiar. Yet every time you get the choice, you still go like, but it could go to my take profit. Hope. So funny. But that is a mindset you need to get out of. Right? You need to understand, you need to learn to trade like a robot, but having, your human brain working. Don't do it on feeling. There's no psychology doesn't belong in trading. This is literally just numbers. Good strategy and a good risk management is all you need. Psychology is nonsense. Now, let's say you want to do a long-term trade. So let's say, what do we have here? What was this? We're going to take this away, by the way. Oh yeah, so let's say we want to buy this because it's more likely, although it's a downtrend, we prefer to take the sell, but there's no reason for me to take just the sell if it's going to go up first and then take the sell. I might as well take the buy as well, right? But here's the question. I want to do a new trade. Now, let's flip this around. In our scenario, okay, this is not correct, but it doesn't matter. Okay, we're actually in an uptrend and I'm at the bottom of the channel, which is perfect, which means that it's a potential long-term trade, right? We have a potential to go all the way up to, let's say this is something what your extrapolation shows. Again, this is an example, this is not correct, so don't, but to iterate the point. You do the same thing as your normal execution, except you now have to decide whether you do the new trade now or after the announcement. Now, if the announcement is in favor of the new trend or the existing trend, you may have a worse entry point. However, if the news announcement is negative for the current trend, you may get a better entry point because the pressure of the trades were already going in one direction. That little fundamental announcement is not going to change that, just temporarily. So what that gives you, if it, for instance, spikes down, instead of opening the trade now, I might be able to open it on another wick like here and take my buy here outside of the trend. It will then correct itself back in. And I basically made a free 30 pips entry point just from that. That's the idea. Now, obviously, it's a lot more complicated than just this, but we're running out of time. So, there would be a lot more steps to this inside your strategy, and obviously more advanced steps as well. Having that said, though, for those with me on the YouTube, I would like to thank you all for watching this. I hope it helped. I hope it's going to help your trading, and I hope to see you on the next one.